Welcome on behalf of the Wagner Law Group to today's webinar on alternative investments during turbulent times. This is the first in a series of webinars we will be providing to you to address some of the special issues and nuances that might arise during a pending recession, a flat economy, even during a very turbulent economy where there's extreme volatility and sharp swings on a daily or weekly basis. There are various considerations that plan sponsors and fiduciaries might want to take into account when dealing with their plan and plan assets during this kind of economic backdrop. And today's first webinar for you is on alternative investments. Why are we talking about alternative investments today? Well, we talk about alternative investments all the time anyway. It's a topic that has its own special considerations. But clearly, during volatile times, you're going to this will be one additional pressure on you when you will be presented with the opportunity to seek higher returns during these flat markets or very volatile markets where you don't know when you can count on. So, with alternatives, why are we talking about it today? Well, we know we're talking about the potential for higher returns, and higher risks. This might be especially tempting during a flat market when you just need some more alpha, some more return, or even even during a volatile market when things are up and down and valuations can skew your assets and reporting over a reporting period. Alternatives will bring you diversification, which of course is something we always look for, but especially in these in times of a potential recession or difficult economic challenges, diversification might be more important than ever. Clearly, alternatives are not legal or illegal per se. They tend to be a little riskier, which is why we always look at them carefully. But any subscriber to modern portfolio theory or generally accepted financial practices and investment practices in the market will tell you that there's a time and a place and a role, depending on the portfolio and the plan, for alternatives. So it's clearly accepted in the spectrum of investment theory. And of course, in addition to turbulent markets or pending recessions, flat markets, so on and so forth, for many of you in the audience, with large DB plans or Taft-Hartley plans, there's a lot of pressure, and there has been for a while, on mature plans where you're not sure where the next generation of employees or participants might be coming from, or it looks as though they're thinning, or they're trending very heavily toward retirees and payouts. Some plans are just a little bit underfunded. They're trying to play the catch-up game, or having just recently caught up, they're kind of they might feel pressure not to let that happen again. So for various reasons, there's always one reason or another why these alternatives look particularly interesting. And we anticipate, with all the talk of pending recessions and so on, that you will see more than the usual number of alternative investment opportunities. Now, a couple of days ago, on November 7th, just to give you an example, the Wall Street Journal had a cover article which was titled, "Pensions Embrace Riskier Investments and Hunt for Returns." That's pretty much it right there. The willingness to embrace, on a reasoned basis, a higher return, provided that you understand and mitigate and address the attendant risks that go with it. It says right here in the journal, pension fund managers are venturing further into unusual investment territory, as this year's plunge in the bond yields makes it harder to find decent long-term returns. Now, I'm not here to give you investment advice per se. I'm here speaking as your legal counsel. Your investment consultants and professionals will tell you about the economics and financial implications of investing and how your portfolio is run. This is simply to say that there are a lot of funds that have been for a while and are continuing to look at, alternatives, private markets, real estate, infrastructure, all kinds of things. Some of these are riskier than others, and some of them might be volatile, but there's a need and a demand to at least consider, in the eyes of the investment consultants, this kind of investment. And that is why we want to talk to you about, kind of how to identify them and remind you, from some of you listening today probably might have already been through this, but we want to remind you how to think about it, how to talk about it, how to analyze it, some of the factors that you want to consider. So, and the trends are very significant depending on which survey you look at. I saw numbers that look like $5 trillion through this year. Defined benefit plans, pushing up toward the 50% mark in terms of the assets that are allocated to what we would consider alternatives. This migration continues. There was a very good report. You can either email me and I'll send it to you, or you can find it on the web. The Georgetown University McCourt School of Public Policy put out a really good study on the use of alternatives to improve retirement plan outcomes, especially as it relates to putting them in on the glide paths for target date funds. But they clearly talk about how, adding, kind of non-traditional investments in terms of, private equity, real estate, hedge funds, or some combination as a way of really getting some better returns on the glide path, so to speak. And that concept applies to both defined benefits and the target date vehicles. I think that there's some challenges. Of course, the report points out that if it was so easy, why don't we see them more often in the DC world nowadays than the DB world? And they talk about some of the liquidity issues and rebalancing and cash flow management issues. They note the rise on the defined contribution side on fee litigation, and note that alternatives tend to be more actively managed, require a little heavier hand on fees. That's a fact to be considered. And just pricing, alternatives aren't always valued on a daily basis. They usually aren't. So there's a question of pricing and valuation and benchmarking and so on. But I just want to point out here that ERISA doesn't have a different standard of care per se for alternatives. I think really what they're saying is that the complexity, maybe the complexity or sophistication of these investments just requires a different level of due diligence or review or maintenance. So in terms of just looking at the investment side of things, you have to look at them operationally a little bit. We'll talk about that further in terms of some of the due diligence steps, but there's no distinction in the regs or in the statute as to any special call out on an alternative investment as compared to what you and I would consider to be a traditional investment. There's also, I want to note for you in terms of statistics and some of the issues, there's some great reports and reading on this. Let me know. You can find them online, or I'd be glad to send you copies if you just email me or call me. Just let me know. The Advisory Council on to the DOL back in November of 2011 did a really great commentary, a report, if you will, on hedge funds and private equity. In terms of the valuation issues, the Office of Inspector General back in September of 2013 did a really nice piece on the need for the DOL to provide additional guidance on how to value hard to value assets. The Advisory Council also did a report just generally back in 2006 on what is a prudent investment process, which is really great reading. It's something that every fiduciary should read once a year. Keep it by their bedside. It's a really great document. The General Accounting Office had a report on DB plans and challenges of hedge fund and private equity investing in February of 2012, and some special testimony they provided in 2011 to the DOL Advisory Council. They also had some testimony back in 2010 on special challenges that DB plans face on valuation and investing in hedge funds and private equity. That was testimony to the House. So there's some really good material, well thought out and documented material. It shows all the trends, for increased investment and allocation in this area, some of the issues, some of the market statistics, a lot of great information there. And again, please let me know if you'd like to see any of it. So again, we're talking about alternatives because everyone else is talking about it. All, the department is talking about it. The General Accounting Office is talking about it. The consultants are presenting it. it kind of raises the question, especially during these tough times when you feel challenges to get better returns. Well, if everyone else can do it, why not me? That's kind of a dangerous trap to fall into. Everything really needs to turn on your own circumstances, your own portfolio, your own needs. And there's also, I think, a little bit of a differentiation, which we'll talk about later on, in the defined benefit world with a pooled investment versus, individually directed options in the defined contribution account. There might be maybe a different way to think about it. See if I can advance the slide here. Thank you for your patience. So a lot of people, it's interesting just to rephrase, alternatives is a very broad phrase. It's not a technical definition that's defined, by the SEC or the IRS or the DOL or anyone in the investment community. It's not a one-size-fits-all. Some alternatives, they're interpreted differently by different people. They can mean different things. Alternative, if we can be talking about private equity. We can be talking about commodities with some really interesting, strategies on, going long or short, derivatives, futures, swaps, some really exotic kind of things. It could be venture capital. Maybe it's private debt. Could be real estate, closed-end funds. We're seeing alternative investment opportunities presented in infrastructure and hard assets. I think that, generally speaking, you're going to see alternatives are going to mean investment options other than the traditional, registered stocks and bonds that you can buy and trade on the exchanges, or, fixed income or, cash equivalent, money market funds, things like that. It's going to be non-registered. Some of them might be pooled investments where you and other investors are going into one common fund. Some of it might be direct, where you're not going into a fund, but you're going directly into a debt instrument or, financing a hotel construction or something, a hard asset like that. It could be a lot of different things. I think it's fair to say that alternatives are going to be unregistered. They're not going to easily fit into the traditional category of equity or fixed income. They're going to tend to be diversified. They might be touching assets you don't necessarily see in that traditional mix. They tend to be a little riskier. When judged with traditional investment metrics. They're not going to be valued every day, which means it's going to be harder to value. They don't mark to market every day. They're not traded every day. And they're going to be, they tend to be illiquid. So, these alternative investments, you might need to be tying your money for 5, 6, 7 years. So those are some of the things that will stand out in terms of what alternatives are. And also, in a lot of instances, they're going to be, certain, hedge funds. The word hedge means to take a position. A hedge fund really is kind of a catch-all for a group of assets that are moving in a contrary fashion to the market. And the investment professionals will tell you sometimes it's good to have some assets that aren't correlated to the market. When the market goes down, use some stuff that stays up a little bit, things like that. So those are some of the things that I mean when we're talking about alternatives. So you're the plan sponsor, you're a fiduciary, you're trying to make a decision about, overcoming, you need more returns, you're overcoming challenges, in your fund. How do you get there? You're presented with these alternatives. They look really good, or they look at the potential for solving some of your problems with higher returns. So it comes as no surprise. There's a lot of that there's a lot of responsibility here on you as a plan fiduciary, and you're going to be asking yourself questions like, what's my standard of care? What's my responsibility as an ERISA fiduciary? Is there anything special about these alternatives I have to worry about versus my traditional approach to other investments? And what about diversification or just general prudency? What about the liquidity of the fund? Yes, those are all things you need to think about, and we'll talk about it. You could ask yourself, are there any prohibited transactions I need to worry about? And yes, of course, you always need to worry about those. You're going to ask yourself, what about this fund-to-fund investing? What if I'm investing in a fund which in turn makes investments, on a pooled basis? What if myself and 10 other defined benefit plans or 20 other defined benefit plans or 50 other defined benefit plans or Taft-Hartley funds are invested in this fund, which in turn makes these investments. Do I need to worry where those investments go? What asset do I own? Do I own an investment in the fund itself? Am I deemed to own the underlying asset? What do I need to worry about, what's referred to as the plan asset rules, real estate operating company exception, venture capital, venture equity, operating company exceptions? Yeah, you need to be aware of those kind of things. We'll talk about it a little bit. Is the person managing my money itself going to be, himself or itself, herself, going to be an ERISA fiduciary? Who's the decision maker here? Who's sharing the responsibility? Is it all on me? Performance fees. A lot of times you get pretty big payout to these fund managers with carried interest and what have you on these hedge funds and other alternatives. They have the chance to make some big money. Is that okay for ERISA purposes? Performance fees? And what if they're offshore? I understand that sometimes these alternatives are offshore investments, or I've heard about offshore blocking funds and feeder funds. What does that mean? Yeah, you have to remember about the fact that from an ERISA perspective, the indicia of ownership has to be maintained in the United States. So these are all things that you need to be on the alert for when you're looking at the structure and consequence of various alternative investments, kind of from a prudence point of view. We'll talk about them a little bit as we go forward. So, in general, what are some of the considerations that I want to be thinking about under the Prudence regulation of 404A? I know I need to be thinking about diversification and liquidity. At the end of the day, I think the real question is, does it further the plan's purpose? Clearly, ERISA, I'll give you a little reminder here. ERISA gives you some very strict standards that assets be invested with care, skill, prudence, and diligence. This is effectively, the prudent person rule that came out of the common law of trusts. And, how is that prudence going to be judged? I suppose it's judged primarily, as an objective test. The heart of the test is whether, the fiduciary has followed the right process, has conducted an independent investigation of this particular investment, and did they employ the appropriate methods to investigate this investment's merit and structure of this particular, alternative investment. And this is very much process-driven, as you know. That's why your due diligence is going to be so important, and relying on your investment consultants and attorneys, counseling, getting the right team together to really assess it. So you have to pull all these things together when you're assessing the alternative investment from a prudency perspective. But it's really no different than any other investment. This might be a higher, maybe a tougher bar, maybe it's a heightened bar because of the complexity of the alternative, like I said before. And clearly, the DOL prudence regulation itself says that you have to consider, the facts and circumstances that or should know are relevant to this particular investment or investment course of action, including the role that this investment plays in your portfolio. In other words, why am I putting this alternative at this level, or this level of concentration, or this dollar amount into my portfolio, and have we acted accordingly? And in that context, you need to be thinking about, among other things, the plan's liquidity, the current diversification of the portfolio as a whole, how this adds or subtracts from that, the projected return relative to whatever the funding needs are of your plan, and the opportunity for gain or loss, all things considered. Like I said before, at the end of the day, is this investment going to help you reasonably further the purposes of the plan itself? And I think those are the kind of questions that you're going to want to be asking and dealing with, on a prudence basis. From a diversification point of view, a lot of times, prudence and diversification kind of merge together. But clearly, from a diversification point of view, You want to make sure that you're not overly concentrated in one, in one particular, asset class. It has to be appropriate for your plan, one geographic area, one type of alternative. Those are the kind of things that you're really looking for on, I think on diversification. So again, you're going to get, you might get some different correlation to the market. You're getting a higher return, but you have to think about liquidity and risk. At the end of the day, if you're a mature plan, is this going to help you solve that problem? If you're underfunded, is this going to help you solve that problem? Does it help you catch up? Those are the kind of questions and things that you want to be asking yourself. Now, from a due diligence point of view, those are all the questions, and you might develop checklists. We sometimes work with checklists on the clients. I know your investment consultants might have checklists to help you. Due diligence is really important. Like I said earlier, this is a very process-driven, especially process-driven investment, given the risks and rewards that go with alternatives. Do your plan documents allow for this kind of thing? Does the IPS allow for it? Do you know the investment? Do you know how it works? Do you guys really know? Do you really know what a long-short strategy is in this particular category? Do you understand how this particular commodity functions, or if you're investing in a hard asset or real estate, the underlying, operations of that real estate? Do you know the investment? Do you know the terms and conditions? Who are the other players? Are there any other brokers or registered broker dealers involved, or brokers that are introducing and executing on these trades, custodians, administrators, other vendors, lawyers, CPAs? How does the whole thing, who are the other players and what roles do they play? How is all the responsibility operationally and in terms of legal accountability? How is that all sorted out? Who's actually in charge of investing? You have to kind of ask yourself that on our end, who made the decision to get into this alternative investment? And once we give someone our money, who pulls the trigger at that end? Who's the decision maker, with the fund or with the management team that we've given this money? Ask yourself, what if this thing was a total flop, a total investment failure? It was a wipeout, notwithstanding our best efforts and our best diligence. What does that mean? Is there a plan B? What happens if it is a total wipeout? Is that going to leave you short from a liquidity point of view, or in terms of the commitment you're making? What if you can't get out? What if you have to stay in for 7 years and it turns out that it's not appropriate for 7 years? You need to be out after 2. If you have some other challenge that's arisen at the plan. Is it just appropriate for the plan? Can it fit? Again, I'm not saying that alternatives are inappropriate. I'm just saying that they require a little, a different kind of scrutiny and thought process because of the risk that goes with it. Does it make sense for your plan? Your investment professionals can help you deduce that, and as legal counsel, we can help you get the right process in place for making that determination. End of the day, pretty simple. I'm taking some risk. Is it worth it if I win? And can I handle it if I lose? How good is the management team that we're giving this to? I mean, what is our own expertise in terms of assessing this? Do we have the right investment professionals and lawyers? And, typically you get, your professional consultants might help you on your portfolio construction. Legally, we're here to deal with legal issues and whatever other common sense we can add to that. You have your, internal accounting, because you have financial statements on your plan. This is a hard to value asset. What does that mean in terms of annual valuation? What does it mean in terms of your 5500 reporting? How do you show the numbers on it? The same thing when you're outsourcing all this stuff to a third party. Do your managers and consultants and lawyers and accountants know what they're doing with this kind of investment? And the actual investment management team itself, do they know what they're doing? You have to look at the fees. At the end of the day, I think it's generally accepted that, higher risk, higher return generally comes with higher fees. That's okay, given, that's not necessarily good or bad per se, but you have to kind of look at the fees and be aware of those, especially because of performance fees. As a lot of a lot of times you'll see a carried interest or some kind of, special fulcrum fee or something that's associated with the advisor to the fund or the manager of this operation, which is okay. You want to get reps we want to make sure we have representation from them that their fee is legally compliant from their structure. ERISA has its own additional overlay on performance compensation. There are 3 or 4 advisory opinions out there that give us some non-exclusive safe harbors on advisory fees. We need to make sure that these fee structures work and they could pass, they could pass ERISA muster. And again, that's where legal counsel can especially help you. I can't stress enough how important it is to have a good liquidity review, especially in DBs. You have liabilities that mature every year as people retire. And participants and P's and B's, participants and beneficiaries continue to draw on fund benefits. Wow, what happens if all of a sudden a 10 or 20 or $40 million investment just got locked up or didn't pay out or whatever? Are you okay? Can you meet liquidity needs going forward? That's a very important thing to consider. Of course, you'll do that with your actuaries and other consultants. The documents. There's a ton of documents that go with these deals. I'll mention them a little bit later, but you really want to make sure you've got all the right paperwork, that you've read everything carefully, and that they've made the appropriate reps and warranties and descriptions, that the people that are presenting you with the deal summary and the term sheet and the agreements and the fact sheets, surveys, the evaluations, the appraisals, so on and so forth, kind of have relied on good people and know what they're doing. Just general ERISA compliance. Are we running in any prohibited transactions? Are the fees reasonable from an ERISA point of view? Any problems? Are we running into any prohibited transactions because of the affiliated network of players that might be involved on the deal? Is someone advising this, where there's an affiliate that's involved? Those any conflicts? Are they properly disclosed from an ERISA perspective? Are they properly mitigated or exempted to the extent we need them? Just real common sense. I mean, what's the track record? If this is one of those new to the market, too good to be true, sometimes that might be interesting to look at. But what if these managers and principals have never done it before? What's the track record? That's always a very valid question. This is all common sense. Just a good reminder, I think, for the kind of things that you want to be thinking about in alternatives. Structure is really important. Plan assets. Why is that important? Well, as an investor, as an ERISA investor, if you're putting your money into a pool, you're held to a pretty high standard of conduct. No need to remind you of that. You have to look at standards of care, prohibited transactions. When your money goes into a fund, for example, does it remain characterized as ERISA money? In other words, does the manager of that fund have to treat that money, have to treat those assets the way you do? In other words, is the fund manager also going to be an ERISA fiduciary? And, that's when we get into the plan asset rules. And some of you might know certain funds, if 25, below the 25% level, it's deemed to be an insignificant benefit plan investors. So then that fund manager won't be a fiduciary. On the other side of that line, they will be an ERISA fiduciary. Those assets are treated as such. Generally speaking, you look through, if I'm investing assets, somewhere, and if I'm investing my money somewhere and it goes somewhere else, it tends to follow through. There's some exceptions for publicly offered securities, mutual funds. There's some exceptions for operating companies and things. So we can, your attorneys help you figure out, once the dollars leave your fund, what does that imply in terms of ERISA responsibility? What asset do you end up really owning? And is the person handling that money and ultimately investing your money or owning the property that your money purchased, are they also deemed to be an ERISA fiduciary or not? Those are important things to consider, because when you are an ERISA fiduciary, if that status does follow through, very high standard of conduct, you have to navigate your prohibited transactions, be aware of the Internal Revenue Code excise tax issues, deal with conflict issues in a certain way. As I said before, ERISA, performance fees, they probably need to be bonded for ERISA. And also, depending on what kind of deal you have, where the deal is structured, plan assets have to have the indicia of ownership in the U.S. So if you're in some venture involving offshore partners or assets, you need to make sure that the ERISA assets stay on the U.S. side of that ownership equation. So these are the reasons why we look at plan structure and the plan asset rules and the exceptions to plan assets and why they matter. You're going to see different vehicles, by the way, We're going to see, you know, limited liability companies, partnerships, corporations, offshore vehicles. Sometimes the investment we make might be pooled with others. Otherwise, it might be direct, you know, into a fund, which then goes somewhere else. Otherwise, it could be a direct or a co-investment in something. You also might see statutory trusts. We're also going to see and hear about, you know, master feeder funds and offshore feeder funds, which sometimes used for tax purposes, fund of funds, multi-class and series funds, parallel funds. These are all different structures which maybe imply different, you know, rights of ownership or, you know, voting and things like that. They can have different tax structures, different protection of the assets. So these are the kind of things that we want to be very careful that we look at when we're evaluating. One of the issues that comes up sometimes that people aren't always focused on it is UBTI, unrelated business taxable income. So if you stop and think about it, as a tax-exempt entity, you know, you're given tax-exempt status. That's part of the public policy behind retirement. You're given tax-exempt status. The money grows tax-free until it's distributed. It's a way to help, you know, support retirement income. But what if your retirement plan, you know, invested in a gasoline station and it opened the gasoline station, it made money, you know, selling gas at the pumps and selling, you know, Coca-Cola and potato chips inside? Would it be taxed on that income as well? If I was on my own running a gas station, I would say, hey, that's no fair. That tax-exempt vehicle can't be in the same business I'm in. I have to pay taxes on my profits. That tax-exempt vehicle doesn't. So we have a whole law, if you will. There's a whole regime and a whole set of rules that deal with unrelated business taxable income. There are certain things that tax-exempt vehicles cannot do, or otherwise they will be taxed on that income. So some of these direct investments, you know, in venture cap, maybe in operating businesses, or alternative investments in an operating business, or in real estate, if you're involved in the operations, if you're somehow deemed to be operating in an underlying business itself, and that, you know, it's carried on, you're regularly carried on, it's not related to your tax-exempt purpose, you're going to be taxable on that income, which, you know, hey, maybe that's not a bad thing. Maybe the after-tax return is still pretty good. But and also, anytime that you have debt-financed income, you're going to trigger some unrelated business taxable income issues. So, you know, we always need to look at the potential for UBTI on these alternative investments. It oftentimes is there, and it's something that we need to be aware of or navigate around or mitigate. For example, you know, there are certain types of income, you know, passive income, for example, you know, interest income, which is not taxable. There's some exceptions to the definition of what's going to be UBTI, so we're looking for those exceptions. We've also got certain structures. This is where sometimes you hear about offshore blockers, where maybe there's a way to have an offshore blocker, you know, we kind of, you know, take out, you know, we kind of deal with these potential tax issues offshore. And there's also, anytime that we have the potential for taxable income, even if we think it's not taxable today, you never know. There's always a lot of interest at the legislative and regulatory level on going after income which is perceived to be unfairly, you know, held as non-taxable income when it should be taxed. So you always have to keep your mind open for what's happening on the legislative and regulatory front. We'd all be on the lookout for that. And in addition to, if you do have unrelated business taxable income, there could be with some withholding. There might be some special reporting or disclosure involving, you know, like maybe there's foreign banks involved. Maybe at the state level, all of a sudden you have to file tax returns. Who knows? So there's lots of things that go with UBTI that we need to stay focused on. Now, it's very common on these alternative asset deals to, you know, there's a lot of documentation that goes with it. And one of the things that we see most often are side letters, where the ERISA plan investor is going to make you get terms and conditions in your offering memo, term sheet, deal, you know, contract, whatever it is. But a lot of times we will, for various reasons, be looking for side letters, which you would add, we try to negotiate with the manager or the offeror, if you will, of the investment. The issues that we typically get involved in, we might look for some, you know, most favored nation clauses Might be certain instances of confidentiality where we're either asking for it or maybe we're getting bound to it in some ways. Clearly, we want to know whether or not the fund, this person that has our money, is an ERISA fiduciary or not. And sometimes, if they're not, we might ask them to hold themselves to that standard anyway. I mean, why not? Hold yourself to that higher standard. We hold ourselves to that standard with our money. We want you to hold yourself to that standard with our money as well. Could be choice of law, things like how many do we get in a board seat? Maybe we want a special legal opinion. Maybe that performance compensation for ERISA purposes we're not quite sure about. We want you to give us a legal opinion that it's okay. Certain special indemnifications and other reps and warranties. A lot of times ERISA plans get into a situation where they might need to withdraw early, get some special redemption rights because of liquidity needs back at home, or they find out that other co-investors have, we think we're in an all ERISA fund, and some of our co-investors have lost their, ERISA status, and now we're mingling our money with non-ERISA plans. That's a problem. So we want to get out or redeem, things like that. And because of the nature and flow of these monies, anti-money laundering reps would be fairly common. Sometimes it's just a question of a successor trustee to the plan. So there are lots of things. There are lots of areas where you might want to negotiate side letters, and we can do that with the fund manager. That's pretty common in the alternative investment world. In terms of the documents themselves, there's a lot of paper. We might have an offering memo or term sheets, a fund fact sheet of some sort. There might be all kinds of subscription agreements and questionnaires, various investment manager and sub-advisor agreements among the various parties, vendor agreements. And of course, the vehicle formation, it's going to be a governing trust document or a partnership document or a limited partnership document, LLC, articles of incorporation, special disclosures, kind of the corporate, the corporate infrastructure, if you will. We're going to want to see all that. If there's been any opinions given or anything from, any regulatory letters from tax authorities or securities law authorities involving the transaction, we might want to see if it's been issued. And again, when we look at this, it's not just through the ERISA lens. Some of these deals can be fairly complex. So we want to think about, is there anything we need to think about here in terms of the DOL, the SEC, the Internal Revenue Code? What about the myriad of privacy laws? We have 50 states, 50 sets of privacy laws to think about, in addition to the very few overarching federal privacy laws like Reg SP and what have you. Maybe there's some banking laws that are involved. There's something special from the commodities exchange or commodities regulation. So we need to think about the intersection of various regulatory regimes when we're working on when we're looking at alternatives. Alternatives, usually you're tying up your money for a long period of time. They're not, as I said before, they're not registered for the most part. They're not going to be valued daily. They're illiquid. So that creates some questions in terms of, well, how do we value them? How do I do my financial statements? What do I do at 5500s? And there's a lot of responsibility. I think you really need to coordinate with your CPA on the plan side and get some good information from the offeror of the investment as to what they're doing. You can get confirmation of holdings and things like that, but valuation, for the financial statements is a different matter, as is the 5500. At the end of the day, it's not your CPA that makes that call. It's not your accounting firm. It's going to be the plan fiduciary is the one that has to have the right information and the knowledge to properly assess and evaluate these things and deal with them as to how they show up on a financial statement, on an audit, and on a 5500. So it's a lot of responsibility there. You also get some strange, potentially some strange timing issues. If your plan is on some reporting regimes are going to be on December 31, the plan might not be on a calendar year. You're out of sync with end of year reporting, and how do you close those kind of gaps? So these are some issues that we need to think about up front. Audit issues, financial statements, audits, valuation, and how to deal with them. Those are issues that we really look to the accountants, especially for their expertise and support. You know, prohibited transactions, you know, as I mentioned, you know, just generally speaking, there's no special set of rules that applies to alternatives. It's the same PTs and other issues that apply to any plan and investment. In the alternatives world, we're looking at, you know, for conflicts, you know, self-dealing, you know, proprietary product, excessive fees. And a lot of times these transactions, there might be structured so that the entity offering the deal, they might have a QPAM, they might also be a QPAM, which helps get you through many of the issues, though not the 406B issues, but it'll get you through a lot of the other issues involved. That's a good thing to look for to see if we need it. You want to see if any other exemptions are available. And sometimes on an alternative, if there's a 406B issue, you might need that DOL exemption, or you might, you know, or maybe there's a way to resolve it with an independent fiduciary. It kind of depends. Usually, you know, you would need an exemption if there's not already a class exemption for it. There might be a class exemption that calls for an independent fiduciary. But I think independent fiduciaries can play an important role here to help bridge the 406B issue, and also a lot of plans, you know, institutional plans or Taft-Hartley plans. On some of these alternative investments, the board of trustees, you know, the fiduciaries might not feel as though they have the particular. It's one thing to, you know, look at some, you know, I want to say standard or traditional equities and fixed income instruments. You know, alternatives is it's a different transaction, it's a different investment. And what we see a lot of times is, you know, people will look, the board might want to get a second set of eyes, if you will, and it might rely on its legal counsel for a legal opinion, or it might rely on an independent fiduciary to come in just as a second set of eyes to say this is okay. In our fiduciary opinion, we'll share that responsibility with you as a fiduciary, as compared to being your lawyer and giving you a qualified legal opinion. Or they might even be given discretionary authority. The trustees might say, you know what, we don't even want to decide this particular, we love this real estate opportunity, it's a big slug of money, we don't even want to decide. We're gonna let the independent fiduciary along with the real estate consultant you know, make this decision for us. And they're given the independent, you know, discretion to make that decision. So those are some of the things that we see on prohibited transactions, you know, meeting the standard of care, if you will, and avoiding prohibited transactions, you know, kind of looking at, you know, at QPAMs and class exemptions, independent fiduciaries if you need to. The other issue is kind of a subtle issue here is this comes up to play really more on defined contribution plans where alternatives are making more of a showing these days with defined contributions, with self-directed accounts, but nowhere near as strong as present as they are on defined benefits and pooled investments. Remember and be careful that on a defined contribution plan, you know, one of the I think it's 401A11, one of the requirements is you can't have any disparity in benefits, rights, and features. So in terms of offering and utilization, if you have, you know, a retail investment fund, if you have a retail alternative product, and they do exist. There are some retail hedge funds, if you will, that fall outside of the traditional category. They give you a lot of diversity and some other things. You need to watch out for how they're utilized between the highly compensated and the non-highly compensated. If you end up with these alternative investments that are either offered only to the highly comps, or they're utilized only by the highly comps and not by a successful percentage across the board, you end up running into smack dab into violating the benefits, rights, and features. That's a plan sponsor issue. It becomes a qualification issue. It's a discrimination issue, and those are the kind of things that you need to be thinking about. I think I mentioned before plan liquidity. It's really pretty simple. You can forecast, you know, how much money you need liquidity every year. I mean, every portfolio has a reasonable amount of liquidity in terms of just what's a reasonable allocation to cash from a prudency point of view. We also have real operational liquidity needs every year. And I think a lot of times people get caught up in the excitement and the opportunity of alternatives, but they haven't really fully thought through and considered how much money do I need? What does it look like I'm going to have to write a check for the next 3 years in terms of my participants and beneficiaries? Am I good to go? Am I liquid? So I think it's really important to get a liquidity review as a precursor to alternative investments. It's one of the most core due diligence steps you can make, depending on the investment and the size of your fund and what your liquidity needs are. That liquidity review can be more or less granular or complex, but you need to have some sense of what your liquidity needs are, and that'll really help. Again, fees is always an issue. Fees have to be reasonable. Does anyone providing a service, including an investment service, has to be reasonable to get your 408B2 kind of exemptions. You have a duty to defray reasonable expenses as a fiduciary when you're selecting investments. So, again, fees have to be reasonable. It's not there. It doesn't have to be the cheapest, and you're not penalized if it's the most expensive. They have to be reasonable in the context of the product and the service and kind of what you're getting for that particular investment. So that's something to consider. And I think I mentioned earlier, you're going to see a lot of performance comp provisions, on these alternatives. The Advisors Act has its own regime on fulcrum fees and other forms of, performance comp. ERISA has its own overlay with several, advisory opinions that are non-exclusive safe harbors. Need to make sure they work under, that they work for the investment and for the fund. And again, just from a structuring point of view, even if they work today, you have to stop and just think about it in terms of, the waterfall, nothing, for the first 3 years, and then, 25%, do you have the opportunity to claw back fees if need be? Are they offsetting, should they be offset, or are they offsetting anything? What about tax law changes? There's a lot of focus on carried interest. How will they impact everything? So a lot of things to think about in terms of fees. These are some of the questions that we would help you look at up front on an alternative. I think, I mentioned before, we're starting to see more alternatives available in the defined contribution world on the retail platform. They've been very heavy in the DB world for years, but now they're moving, more to the DC. And I think, that's been the question. Are we depriving participants the opportunity to earn some of this alpha, some of this extra return that people talk about? So yes, we're seeing more alternatives there. It's a slower migration. We're seeing some TDFs that are considering alternative class. I mentioned before the report out of Georgetown, how they're using alternatives to build out TDFs on different kinds of alternatives on the glide path. We don't really see on the DC plan as of yet really anything in terms of private funds, or we don't see too much in terms of private funds or illiquid, non-registered assets. We see some retail opportunities, retail fund of funds. They tend to be kind of expensive because you have one manager on top of another on another. They're also actively managed usually, so they tend to be a little more expensive. But there could well be a place for them on your investment menu. That's something to think about in the context of your plan with your attorneys and your consultants. So we always talk about liquidity in terms of defined benefit plans. Is there a liquidity threshold for defined contribution? I think maybe there is. It's defined a little bit differently. I mean, it's defined. I suppose it's people. You're going to tend to see money in motion at age 65. It's going to at least roll over to, I say 65, at retirement. It's at least going to roll over, if not be, cashed out. So you have to think about, liquidity maybe a little differently for DC plans, but there could be one. But again, remember, there's all the legal permissibility, the availability of these funds, alternatives and traditional investments, they're all subject to the same criteria, the same rules, the same availability perhaps. There's just a little bit of a different analysis perhaps that should be run on alternatives. Governance is another issue. Like I said, I mentioned earlier, on the investor side, who is making the decision to put this money into the alternative? How is that money allocated? You've got boards and investment managers and plan sponsors. If it's a DB plan, if you single employer plan, named fiduciaries. Who makes that decision? Are they relying on an independent fiduciary? Is there a particular fiduciary that's named for it? Understanding that governance process, who is really making the decision internally, is really important. And the same thing with the investment vehicle. Once the money leaves your door and goes out, who really is going to manage and control your money? Who's the decision maker on the other side of the fence? investments. It's really important to understand that. One of the big concerns we get is withdrawal rights. Because of liquidity, it's very common you have to really consider the long-term play of these alternative investments and how that impacts your liquidity. A lot of times we'll see side letters negotiated, around withdrawal rights, where if certain liquidity needs arise, a plan might be allowed to get out early or get a certain distribution. Or if the fund that you invested in is no longer an ERISA fund and you want it to maintain, you want the management team to have that kind of ERISA fiduciary responsibility, that would be a chance to exit. Or maybe there's some other ERISA violation. You don't want to have your money pooled in a fund where there's an ERISA prohibited transaction or something going on. So those are the kind of things that we're thinking about with withdrawal rights. Again, these alternative investments tend to tie money for 5, 6, 7 years, maybe longer. So what does it all mean at the end of the day? What are the takeaways here? You're going to be seeing alternative investments as a matter of course. You're going to see even more of them. As people talk about recession, the demand, the concern about how am I going to fund my plan? How am I going to get returns? We're hitting a recession. Where's my investment return going to come from? You're going to see even more alternatives than usual. So we want you to be aware of what they offer and how to look at them especially through the legal lens. So what are you going to do? Well, pretty common sense. You have to identify the risks and rewards. You have to think about the legal issues operationally. How's it going to work? How's it going to impact my audit? Any tax issues? What does the structure mean? Who makes the decision before investing? You need to have a good teamwork with your internal, your internal board, your internal fiduciaries and internal staff, and your external, investment consultants and auditors and attorneys. You need a very clear understanding of liquidity. What's the risk and reward? How does it fit in your portfolio? Where does the fiduciary decision lie for this? Do we want to allocate responsibility? Do we want to take a step and allocate it to an independent fiduciary or something like that? Can we handle it with our existing structure? And as always, because this is such a process-driven world, document. I can't emphasize it enough. Keep good minutes and records of the questions you asked, the answers you were given, how you approached it. Remember, this is because of the procedural nature of satisfying your fiduciary standards. Just having good records for the questions you asked, who you spoke to, how you went about it, even in the event of not hitting your return or even a bust. That's not fatal per se. You want to be able to show that you undertook the right investigation, asked the right questions. You need to keep good files and good documents for that. So having said that, I thank you for listening to our webinar on alternative investments and how you might be thinking about them during the approach of recessions or kind of tricky economic times. If you have any particular questions or need for any additional documents, please give me a call. My phone number and email, I think, is on the first slide. And I would love to have the opportunity to speak with you, and we'll send you any information that you need. So thank you very, very much. And stay tuned. We're going to have a series as we round the horn into the year 2020. We have several more webinars coming in our series of how to think about and prepare for your plan during, pending times of, recession or economic volatility. Thank you very much, and happy holidays to all of you.